That was a sign that something was getting different and that people weren't just shifting between.
The problem was the very heavy concentration of the
Government debt is actually a good thing because it allows households.
They're huge, and we don't necessarily have alternatives.
And that was unprecedented and something that woke up, I think, a lot of people.
Countries are starting to get worried.
The regime has...
For the first time in decades, global investors fled from the United States instead of seeking its safety. The reason? Rising doubts about America's national debt. When does borrowing become a ticking time bomb, and how close are we to crossing that invisible line? What is the U.S. national debt and how did we get here? The U.S. national debt represents the total amount the federal government owes to creditors, both domestic and international. This debt accumulates when annual government spending exceeds tax revenues, resulting in persistent budget deficits. Over the past 2 decades, the country has consistently spent more than it collected, leading to a debt level now comparable to that seen during World War II. The government raises funds by issuing treasury securities, which are purchased by individuals, institutions, and foreign investors. These securities are considered safe investments, making them attractive worldwide.
trade abroad.
Trump announced these sweeping tariffs. We immediately saw a pretty stark reaction.
Tariffs rattle markets with a sweeping sell-off.
Is it the end of U.S. exceptionalism?
The simultaneous decline in the equity market, in the bond market, and in the U.S. dollar, all three of those together.
The debt is best understood as a percentage of gross domestic product, which provides context for its scale relative to the economy. Today, the national debt influences nearly every aspect of economic life, shaping policy decisions and affecting the nation's financial stability. Why some government debt is actually good. Government debt can play a crucial role in economic stability and growth. By borrowing, the government can finance infrastructure projects, support public services, and respond to emergencies such as recessions or pandemics. Issuing debt allows households and institutions to invest in low-risk assets, providing a safe place to store wealth. Strategic borrowing during downturns helps maintain living standards and can stimulate economic recovery. When used wisely, debt enables long-term investments that private markets might avoid due to risk or scale. For example, during the 2020 pandemic, increased borrowing funded relief efforts, supporting millions. The presence of government bonds in financial markets also helps set benchmark interest rates, influencing lending and investment across the economy. In moderation, debt acts as a financial tool that supports both stability and future prosperity. When does debt become a problem for the economy? Debt becomes a significant economic problem when it grows faster than the economy's ability to support it. High levels of public borrowing can crowd out private investment, as funds that might fuel business expansion or home loans are instead directed to government securities. When the debt-to-GDP ratio approaches critical thresholds, such as 175 to 200%, servicing the debt through taxation alone becomes nearly impossible. Investor confidence may erode well before reaching these levels, leading to higher borrowing costs and reduced demand for U.S. assets. If markets sense that policymakers lack a credible plan to manage debt, they may demand higher interest rates, trigger a cycle of rising costs, and reduce economic growth. Such a scenario can spark a fiscal crisis, with widespread impacts on employment, investment, and public services. The impact of rising interest payments on the budget. As the national debt grows, so do the government's interest payments. These payments are obligations to creditors and must be met regardless of other budget priorities. When interest rates rise, even slightly, the cost of servicing the debt can increase by hundreds of billions of dollars annually. This diverts resources away from essential programs like healthcare, education, and infrastructure.
That makes the economy more productive and allows us to live better. And that's why it matters to the average person. It's the opportunity that we're giving up by financing so much federal debt.
Studies have found that if the debt were to go down to here by 2050, incomes per person would be nearly 7% larger.
The thing about the national debt is it affects basically everything in our economic lives, and then some.
A larger share of the budget goes toward paying interest, leaving less flexibility for new initiatives or emergency responses. Over time, borrowing to pay interest, rather than to invest in productive assets, can trap the government in a cycle of dependency. The risk is that interest payments become so large, they limit the nation's ability to address future challenges or invest in growth, making the debt burden increasingly unsustainable. Hold on a second. Should the government focus more on cutting spending, raising revenue, or both to fix the debt problem? Share your thoughts with us below. Warning signs. When investors start to worry. Investor confidence is a crucial indicator of national financial health. When global markets begin to question the safety of United States assets, warning signs emerge. A sudden decline in the value of the dollar or a noticeable increase in interest rates on government bonds often signals that investors are seeking safer alternatives elsewhere. This shift can be triggered by events such as unexpected policy changes, credit rating downgrades, or doubts about the government's ability to manage its obligations.
The dollar occupies a really special role in the global financial system. It is the world's safe asset, the world's reserve currency.
No currency is as liquid as the US dollar.
The dollar is involved in 90% of FX trades. The dollar is also the global trading currency, right? Almost everything is invoiced in dollars.
If major buyers, including pension funds or foreign governments, reduce their purchases of Treasury securities, it reflects growing unease. The danger zone: debt-to-GDP ratios and fiscal crisis triggers. The debt-to-GDP ratio is a key metric for evaluating national solvency. When this ratio climbs toward 175 to 200%, the risk of a fiscal crisis escalates dramatically. At these levels, the government's ability to raise enough revenue through taxation to cover interest payments becomes nearly impossible. History shows that countries entering this territory often face severe economic consequences, including forced austerity and loss of market access. However, a crisis can be triggered even earlier if markets lose faith in the government's fiscal discipline. A sudden loss of confidence may cause investors to demand much higher interest rates or withdraw their funds entirely. This can set off a chain reaction, skyrocketing borrowing costs, a plunging currency, and a sharp economic downturn. How a debt crisis would affect everyday Americans. A debt crisis would have immediate and far-reaching effects on daily life. As government borrowing costs surge, interest rates on mortgages, car loans, and credit cards would also climb, making it more expensive for families to borrow or refinance. Public programs, including Social Security, healthcare, and education, could face severe cuts as policymakers scramble to meet debt obligations. Job losses may increase as businesses struggle with higher financing costs and reduced consumer demand. The value of the dollar could fall, leading to higher prices for imported goods and everyday necessities. What can be done to prevent a U.S. debt crisis? Preventing a debt crisis requires a balanced and proactive approach from policymakers. The most effective solutions combine spending restraint with measures to increase government revenue. Reforming major entitlement programs, such as Social Security and Medicare, is essential to address long-term obligations.
It ripples through the entire economy in ways that hurts all of us.
If this happened on a larger scale and interest rates really went up for everything, it could spiral into a fiscal crisis.
The problem with a debt crisis is that once it happens, you can't just debt your way out of it.
We might be able to borrow during the next crisis. All we know is we have less space to do so than we otherwise would have.
We're not there. We're not going to be there tomorrow.
Revisiting tax policies to ensure sufficient revenue is another critical step. Implementing stricter budget controls and reducing unnecessary expenditures can help slow debt accumulation. Transparent and credible fiscal planning reassures investors and maintains market confidence. Bipartisan cooperation is necessary to enact meaningful reforms, as piecemeal solutions are unlikely to address the scale of the challenge. Regularly reviewing and adjusting fiscal policies in response to changing economic conditions also strengthens resilience. Ultimately, decisive action today can safeguard economic stability and protect future generations from the consequences of unchecked debt growth. The national debt is not an urgent crisis until the moment it is. The real danger lies in waiting too long to act. History shows that solutions are possible, but only if we face the problem before it spirals out of control. The choice is ours. Thanks for watching.